Good afternoon, everyone, and welcome to our webinar, America's Diverse Family Farms 2015 edition. My name is Nancy McNiff, and I will be your host. This webinar is being recorded and will be posted on the ERS website next week. At any time during this webinar, you may enter a question into the chat feature at the bottom left corner of your screen, and we will answer them at the end of the presentation. Our speaker today is Robert Hoppe. Bob is an economist in the Structure, Technology, and Productivity branch at the Economic Research Service, U.S. Department of Agriculture. In addition to authoring the America's Diverse Family Farms report, Bob's areas of research also include general farm structure, small farms, million-dollar farms, and women farmers. I think we're ready to start, so Bob, you can now begin your presentation.
Okay. Nancy mentioned I'll be discussing America's Diverse Family Farms, the 2015 edition. This is a ERS brochure that came out in December of last year. It emphasizes the diversity of farms in the United States. This sort of information is interesting and also important in understanding the farm sector and farmers. One of the main conclusions of the brochure is that farming is still overwhelmingly made up of family businesses, but family farms differ in size and other characteristics. Our main data source is the 2014 Agricultural Resource Management Survey, or ARMS. The 2014 version was the most recent ARMS survey that was available. ARMS is an annual survey of farm businesses and their associated principal operators. The principal operator is the operator most responsible for running the farm in those cases where there's more than one operator. And when there's only one operator, the principal operator is the sole operator. The survey uses sample weights to accurately represent farms and production in the continental United States. The survey is conducted by the National Agricultural Statistics Service in cooperation with the ERS. Before we get too far, we need to define a couple of terms. Those terms are farm and family farm. A farm is any place that's sold or normally would have sold at least $1,000 worth of product in a given year. A family farm is any farm where the majority of the business is owned by the principal operator and people who are related to the principal operator. The relatives do not necessarily need to live in the same household as the operator. About 99% of the 2.1 million farms in the United States are classified as family farms using this definition. Now, the $1,000 farm definition ensures that many U.S. farms are counted even though their sales and production are very small. As a result, farms are diverse. They range from small retirement and residential farms with very little output up to growing business enterprises with sales in the millions of dollars. As a result of this diversity, ERS developed its farm typology, which brings us to the next slide. Now, the typology classifies farms into more homogeneous groups based on whether the farm is a family or non-family farm, a farm size which we measure using gross revenue, and we also sort small farms by occupation of the principal operator. The goal here is to classify farms with similar characteristics together. I'd like to mention that our measure of gross revenue is defined as a sum of crop and livestock cash receipts, government payments, and other farm-related income such as custom work and production contract fees. Its gross revenue is measured before subtracting expenses. This gets us to the ERS farm typology in detail. The first thing we're going to do is define small family farms. Those are family farms with gross revenue less than $350,000. Includes retirement farms where the operators report that they that they are retired, but they still continue to farm on a small scale. We have all farm occupation farms where the operators report a primary occupation other than farming. We also have farming occupation farms where the operators report farming as their principal occupation. We divide those further into low sales farms with gross revenues of less than $150,000, and moderate sales farms with revenues between $150,000 and $349,000. Brings us to mid-sized family farms with gross revenues from $350,000 to just under $1 million, and the remaining family farms are large-scale family farms. They have sales over $1 million, gross revenue over $1 million. We divide them between large family farms with gross revenues from $1 million to $5 million, and very large family farms with gross revenues of $5 million or more. Non-family farms just don't meet the definition of family farms. The operator and relatives do not own the majority of the farm. Now, that doesn't necessarily mean that they're large farms held by public corporations. They could include relatively small farms operated by unrelated business partners, or a farm operated by a hired manager for a family of absentee owners. About 65% of the non-family farms have gross revenues less than $350,000. First thing we're going to use a typology for is to look at the distribution of farms, land operated, and value of production into four groups: small family farms, mid-sized family farms, large-scale family farms, and non-family farms. Small farms account for approximately 90% of all farms. They operate about half of the farmland, but they only produce about 22% of the value of production. The large-scale family farms, that's the ones with gross revenues of greater than $1 million, by themselves account for about half of the value of production, but they're doing that with only 3% of the farms. Family farms of the various types, if you add them all up together, they account for about 99% of farms and 90% of production. Non-family farms account for the remaining 1% of farms and 10% of production. Now, although small family farms only account for less than a quarter of total production, they are more important for specific commodities. What this graph does is show the distribution of production of various commodities by the same groups we had in the four groups we had in the previous slides: non-family farms, large-scale family farms, mid-sized family farms, and small family farms. The arrangement of the commodities we're looking at is by the share of production that's accounted for by small farms, going from a high percentage to a low percentage. You'll note that over half of hay and poultry is produced by small family farms. Poultry is mostly produced under production contracts. The rest of the commodities shown here, the other groups are more important. For instance, on cotton, you can see that mid-size and large-scale farms account for most of the production. Same thing with cash grains and soybeans, and also hogs. It's the same two groups. Large-scale and non-family farms dominate the production of specialty crops and beef. Large-scale family farms by themselves account for about 75%, about three-quarters of the production of dairy products. Traditionally, we think of farms as having just one operator, but many farms have multiple operators, and some multiple operators have more than one generation involved. The presence of younger operators in multiple operator or multiple generation farms can affect expansion and contraction decisions as well as succession. Multiple generation farms are shown in the yellow here, and a multiple generation farm has a difference of at least 20 years between the oldest and the youngest operator. The other portion of the bar, the blue, are the remaining multiple operator farms that are not multiple generation. Now, multiple generation farms are most common and account for about 20% of farms in the large, very large, and non-family farm groups. Now, the operators on multiple generation farms are not necessarily related, and that's probably more relevant for the larger non-family farms. We mentioned succession in the previous slide, and that's important to farming given the age of principal operators of U.S. farms. This graph shows the share of operators in each group that's at least 65 years old. Overall, about 33% of U.S. farmers are at least 65 years old. If you compare that with non-agricultural self-employed workers, only 12% of them are that old. That line across here allows you to see how each group compares to the share for non-agricultural self-employed. The older operators are most common among retirement farms. Approximately 2/3 of retirement farms have an operator that's over 65, which isn't, you would kind of expect that. Also, about 41% of low sales farms have a large share of operators that old, as do moderate sales farms. The rest of the farms are run around 20%. The advanced age of farm operators, not surprising. It's understandable given that the farm is the home for most operators, and they can phase out of farming over a period of years. The next graph, we're going to look at how profitability of farms differs by size. The profitability measure we're using here is the operating profit margin. The operating profit margin measures the funds available to finance the farm's business capital, given as a percentage of gross income. The funds that we're using in the numerator are basically net income adjusted for unpaid labor. There's three groups we need to look at here. The red zone down here, these are farms with operating profit margin less than 10%. They have a high risk of running into financial difficulties. At the other extreme, we have farms with an operating profit margin greater than 25%. These farms are in low risk for financial difficulties. And there's a intermediate group, the yellow zone, that comes between these two. Small farms are more likely to have a operating profit margin in the red zone. That's the first four bars here. The share of small farms in the red zone ranges from between 53 and 76%. On the other hand, there's also a number that are in fairly good shape with an operating profit margin of at least 25%. But you'll note that the mid-sized, large, and very large family farms have much higher share in the green zone, and also the share in the red zone. None of these groups have a majority of their farms in the red zone. Now, despite the low profitability of most small farms, farm households compare favorably in income with all U.S. households. Each of these bars shows the median household income of a particular farm type. The line close to the axis down here gives you, for comparison purposes, the median income of all U.S. households, approximately $53,700. All the typology groups have a median operator household income greater than the median U.S. household income. Overall, about only 32% of farm households had income below the median for all U.S. households. The share of farms with income that low is highest for retirement farms. Approximately 42% had had income below the U.S. median, and for low sales farms, 46% had an income below the median. Now, for many small farm households, most income comes from off-farm sources. And we're looking at average household income by the typology, and we're breaking it up into two components: off-farm income in yellow and farm income in blue. Note that the off-farm income, the yellow portion, accounts for virtually all income for retirement, off-farm occupation, and low sales farms. It also accounts for a fairly large share of the income of moderate sales households, approximately 73%, and even 38% of the household income of those households on median mid-sized family farms. About half of U.S. farms report negative farm income. The share of reporting a loss are highest for households operating off-farm occupation farms. About 68% of them report that their farm income is negative. The level of income is important to farmers' well-being, but so is their wealth. Wealth defined here as the assets of the farm household divided or minus the liabilities of the farm household, and we're counting both farm and non-farm assets and liability here. This chart is laid out very much similarly to the one on the median household income. You have the median wealth for each group shown with the red bar. We have a median wealth of U.S. households of $82,500, and that's shown with a dotted line here. You'll note that each of the typology groups has a median wealth much greater than that for all U.S. households. Virtually all farm households, about 97%, have wealth greater than the median for U.S. households. Farmland makes up most of the wealth of farm households. Okay, this chart is a little bit different than the previous ones. All the bars of a given color add up to 100%. We're looking at the distribution of different types of program payments across the typology. So in the case of the darker blue here, the land retirement program payments for such things as CRP. If you add up all the numbers for the darker blue bars, here you end up with 100%, and same thing for the others. We're going to start with commodity program payments. They basically reflect the acreage and crops that have historically been eligible for support. About 69% of the payments from these programs went to moderate sales, mid-sized family farms, and large family farms. We're focusing on the red bars at this point. About 60, if you look at the light blue bar, about 61% of working land conservation payments went to mid-size and large family farms. These programs target environmental problems on farmland that's in production. Finally, we get to the land retirement conservation program payments. About 74% of these payments went to retirement, off-farm occupation, and low sales farms. Good to remember, though, that about 3/4 of all farms in 2014 received no government payments. So the effect of government payments on most farms isn't direct; it's indirect. We're also going to look at mid-sized and large family farms receive 70% of crop insurance indemnities. Again, this is similar to the previous chart. All the bars of a given color add up to 100%. And the 2/3 of the indemnities going to mid-sized family farms and large family farms, it's pretty much reflects the distribution of cropland. These groups also participate heavily in the program. About 2/3 of mid-sized farms and 3/4 of large family farms participate in federal crop insurance. Overall, the overall percentage is only about 1/6 of U.S. farms. Federal crop insurance has grown recently, or in recent decades. The amount of land insured nearly tripled from about 102 million acres in 1989 to about 300 million acres in 2014. Indemnities exceeded government payments for the first time in 2011 through 2013. They fell down below government payments in 2014 due to better weather. That brings us to our conclusions and implications. Farming still is largely made up of family businesses. There's nearly 2.1 million family farms, and there's fewer than 25,000 non-family farms. About 99% of farms are family farms, and they account for 90% of production. Small farms account for 90% of farms, but only 22% of production. Nearly half the production in the United States occurs on large-scale family farms, which make up only 3% of U.S. farms. The non-farm economy is critical to small farm operators and their households. This is largely due to the share of small farms that receive most of their income from off-farm sources. Because of this, general economic policy such as tax or macroeconomic policy can be as important as traditional farm programs to them. About a third of U.S. farm operators at least 65 years old. There are some replacement operators working on multiple generation farms. There are substantial numbers that enter farming, but they're not necessarily young people. Growing productivity plus the competitive nature of the market for farm products will mean that there's probably be fewer but larger farms prevailing in the future. Federal different farm programs affect different sets of farmers. Commodity-related programs largely go to moderate sales, mid-size, and large family farms. Working land payments go mostly to large and mid-size family farms. And land retirement payments go to retirement, off-farm occupation, and low sales farms. Finally, federal crop insurance has grown in importance in recent decades. The acres insured has nearly tripled since 1989. Indemnities first exceeded government payments from 2011 to 2013. We have some contact and reference information. You can reach me and my co-author, Jim McDonald, at our email addresses. Our ERS website has a copy of the America's Diverse Family Farm Report that you can download. We also have a farm structure and organization topic page that has information of the same nature that I presented here. And finally, we have an ERS web tool on our website. This allows you to create your own tables using the ARMS data with the farm typology codes. You can also download using different classification variables that ERS has developed over the years. Any questions?
Okay, if anybody has a question, you can enter it into the chat feature on the lower left-hand corner of your screen. We have a couple questions. So you showed that the number of small family farms is about 90% of all farms, and you hear a lot about farms increasing in size. Is that still true?
Yes, the production is shifting to the larger farms. We recently revised the farm typology. In the past, we topped off at $500,000 in sales. We call that large farms with no differentiation above that group, above that level. And the production was shifting up there enough that we had to, in this version of the typology, we had to add more classifications at the top. But overall, the number of farms is fairly stable, but that's due to the fact that the farms with revenues less than $10,000 basically they rely pretty heavily on off-farm income, so they're not they don't go out of business because of things in the farm sector. There is a shift if farms are more in the middle, like the larger small farms have continually over the years between censuses, you can trace a decline in their numbers. But overall, the numbers are stable, but that is kind of masked by stable or growing numbers of farms with under $10,000 in revenue, and that's why it's good to look at a range of sizes.
Okay. Another question is, operating profit margins seem to be very low for all farms, but especially the small ones. How do they stay in business? Do they?
Well, some of them, a lot of them are relying on off-farm income, and the farming part of the operation is strictly a sideline. If you're relying on farm income, you couldn't have margins that low year after year. But if you take somebody that's wants to live on a farm and has a few horses, they're classified as a farm even though they have no intention of selling the horses.
Okay. With small family farms relying so heavily on off-farm income, and with such a narrow profit margin, what's the debt-to-equity ratio for this group? Do you know?
Actually, the debt-to-equity group ratio for
the small family farms.
Yeah, for like the retirement farms, the off-farm occupation farms, and the I believe even the low sales farms is pretty good. A lot of them are, they have substantial assets, and they, if they're older in particular, they paid down their debt. So the ones that have the higher debt asset ratios are the ones that are leveraging to grow or to, or the larger operations basically. Now, it doesn't mean that there's somebody that's trying to make a living on a farm with gross revenue $100,000 doesn't having debt debt asset ratio issues, but all in all, you got to remember, like it's almost half of the farms are off-farm occupation farms, and they've basically got land and very little income from farming. Their debt asset ratio is probably quite good.
Okay, it looks like that's all the questions we have. So thank you all very much for joining us this afternoon, and have a wonderful day, and thank you, Bob, for your presentation.
Well, thank you.